Well, good afternoon, everyone, as we head into US trade on Tuesday, the 8th of August, as sour risk sentiment has continued and worsened over the course of the European session this morning. Now, we were speaking this morning about the Moody's downgrade on US banking stocks, not stocks, US banks, should I say. Cut credit ratings of several small to mid-sized US banks and said it could downgrade some of the country's biggest lenders, which is a bit of negativity and sparked some concerns about the banking sector in the US. Now, none of the large banks have been affected as of yet, but it could downgrade some of the country's biggest lenders, especially after Fitch downgraded US credit ratings last week. Kind of fuels concerns of a bit of trouble going forward. Couple that with Italy's announcement today after dealing a surprise blow to its banks with a 40% windfall tax for 2023 on profits generated from higher interest rates. So the higher interest rates, of loans that are being paid back, loans that the banks have handed out that are being paid back by businesses and people. Now, obviously, they generate more cash as higher interest is being paid. The profits on them being taxed then by 40% by Italy in a surprise move over the course of this morning. Now, what that means going forward, is that likely to filter through into other countries, into other countries and tax these banks after making higher profits from these higher interest rates? Remains to be seen, but a little bit of a random thing. A few market participants seem to think it may filter in to other economies going forward. So certainly not a good development for the Italian banking sector. Plus Moody downgrading US banks. Certainly some banking issues today. Plus, then, if you look earlier on in the year with the banking sector was obviously in a bit of trouble, a number of banks failing, and the Fed had to step in order to lend support to a number of medium-sized US banks early on in the year to keep them going. These developments are kind of a continuation of that. Obviously, it's been a few months since that all kicked off, but markets sold off heavily off the back of that, and this is more concerns to do with banking sectors, not just the US now, with Italy as well. Is that likely to cause more problems going forward with those tax measures? Remains to be seen. The FTSE MIB doesn't like it. The Italian stock market, as I said again, does that filter through into other countries? Something we definitely need to keep an eye on as we head on into the next few weeks. Apart from that, we were speaking of the Chinese data earlier on. Negative Chinese data, further reaffirming the stance that the economy has struggled post their COVID lockdown and continues to struggle as well, and that has further contributed to some downside in risk over the course of this morning. So with Moody's downgrades, with the Italian banking, with the tax on Italian banks, plus couple that with some negative Chinese data, fueling fears of an economic slowdown, plus some sticky Eurozone, or should I say German inflation this morning. It's sort of a recipe of things that markets have not taken kindly to over the course of today. You can see US equity futures red across the board, European, Asia Pacific equities red across the board. Wherever you look, some down by a solid amount, 1.5% on a number of these. US stocks, Russell's down 1.2%. S&P, the Dow and the Nasdaq are all down about 0.7. We have not entered the US session as of yet. So negativity across stocks globally across the board. You can see commodities, you can see oil down 1.5%, was down 2% a few minutes ago, has had a slight bit of a bounce back in the last 10 or 15 minutes. But with that being, with those growth concerns out of China, obviously China are a massive consumer of oil. Again, a slowing economy an economy that is struggling in China is a negative for demand in terms of the price of oil. It is a bit of a pullback against the trend which we were expecting in this morning's video. Managed to catch that short on oil through the head and shoulders. That would have been that was a nice trade, obviously to be expected, or something we did expect in this morning's video pre-European Open. But commodities, copper down as well, silver down, gold down, commodities across the board lower. You can see then bonds are bid, yields are down, which is a safe haven play off the back of equities and commodities being down. You can see the safe haven play further reaffirmed by the US dollar being higher across the board. Now, with bonds higher and yields lower, US yields lower have driven the US dollar lower in recent trade, because that discussion was based off of interest rates, expectations for higher interest rates, expectations for lower interest rates. But this is a clear safe haven play off the back of equity or aggressive equity downside. Yields are then lower because bonds are then purchased for as a safe haven bet, or as a safety bet. US dollars then higher across the board, which seems to be the safe haven of choice over the course of today. Now, the Japanese yen is higher across the board apart from against the US dollar, with the Bank of Japan adjusting monetary policy over the last couple of weeks. Clearly some slight concerns about the Japanese yen at the moment, which is why the US dollar is the strong currency across the board. You can see your Australian dollar, Kiwi dollar lower across the board. The only currency Australia is not lower against is the New Zealand dollar. So New Zealand dollar feeling the brunt of negativity in markets this morning. Kind of a double whammy for the Australian and Kiwi dollars. With that negative Chinese data this morning, the Australian dollar mainly is a good proxy for Chinese data. Obviously, the Kiwi dollar is a good proxy for the Australian economy as well. Couple that with China, and those two currencies have not liked the Chinese data overnight. They have not liked equity futures, or equity downside, should I say, over the course of today. It certainly is a recipe for them to want to continue lower once you take into consideration the downtrend from last week, with those two central banks seemingly done their interest rate hiking cycles. So clear negativity across the board today, which brings us back to the charts, and you can see that relayed in the charts. You can see solid downside on the S&P, the Dow Jones, the Nasdaq and the Russell. The Nasdaq holds firm at this support level, which is interesting and something to note. But going into that US session in about 15 minutes time, if that support level does fold, you would expect this sentiment from last week to kick back in, which, you know, we were talking earlier on today about the Nasdaq and the Russell being the weaker stock indexes. You look at the S&P, the Dow Jones, they a bit more of a bounce back yesterday. The Nasdaq and the Russell did not. The Russell is already through the lows, and the Nasdaq, if it does, if the equity markets continue to be pressured into this US session later on, Nasdaq shorts through that support level do not seem like a bad bet. That is obviously relayed in the DAX, the Euro stocks and the FTSE. FTSE holding somewhat firm at the moment, which is something to note, but clear negativity across markets. I think you'd be a brave person to go long against that. I mean, you could easily turn around and pop back higher into the US session, but is that a trade you really want to take in terms of a probability perspective? A little bit tricky when you've seen such widespread negativity across markets today. You come across to the US dollar, and you can see the Australian dollar, Kiwi dollar, Euro and Sterling all continue lower. You can see dollar Swiss, dollar CAD all pushing higher, with the dollar index through that support level or resistance level earlier on, should I say, through that resistance level that we are looking at over the last couple of days. Dollar yen not really doing too much, both of them seen as safe havens, so not too much, but still up higher off the back of the move that we had in the overnight session. But clear US dollar strength across the board, clear equity weakness across the board. Yields had continued lower to start the session. Now, something of note, yields are posting a bit of a bounce back at the moment, which is interesting to say the least. Now, in terms of what that means going forward into today's session, I mean, bonds purchased off the back of some safe haven plays. Equities are down quite heavily, so I'm not sure really where this goes heading into the US session in terms of a yield perspective. Obviously, if they continue back lower again, you'd have to imagine that is more safe haven flows. If you can couple that with some equity downside, that's something to keep an eye on. But the S&P 500, the Dow Jones and the Nasdaq are not through the lows yet, so still not a complete capitulation, or absolutely not a complete capitulation. We have not seen these break through the lows. If we do break through these lows on these stock indexes, definitely is significant heading into today's session. Oil, we got the bounce back, or the pullback that we were looking at. Looked at this head and shoulders through the neckline, a clear snap of that neckline at 81.50, or at 81.50 should I say. clear downside in today's European session off the back of one negativity in stock markets. Off the back of that, it's a bit of a commodities lower, equities lower, commodities do not like. There's one push that lower off demand concerns from China as well. A couple of things sending oil lower, so some clear fundamental backing on that move lower. Gold has grinded lower, which is off the back of US dollar strength. Now, with yields lower and that grinding lower as well, you'd have to imagine if we do get that bounce back in yields, that gold continues lower off the back of that. So interesting move that going against bond yields. It normally correlates inversely correlates with bond yields, but the fact that these have pushed lower in the morning session so far, gold has pushed lower as well. Obviously it's a bit of a dollar play today, but if they do pop higher aggressively, maybe that means some further downside to come for gold. Apart from that is where we are at really in terms of today's trade. We can see this inflation figure from Germany remaining sticky, which we alluded to in this morning's session. We did have some trade balance figures out of the US, and the trade deficit widens. It also widens off the back of imports and exports lower, so both of them lower, and the trade deficit widens. So bit of negativity there. It's again kind of reaffirms that stance of slow growth in today's trading session. But at the moment, that goes in line with that Chinese data from this morning, which I wouldn't say it's a positive for stock indexes, but markets haven't moved too much off of that, so I will skip on past that. There's no high impact data over the course of today's session, but stock markets remain under pressure. You want to trade a bounce back, it would be a brave decision to go back against all that negativity in markets today. So you probably have to sit on that side of the fence of downside continuing, but if we fail to break through these lows and do start to pop higher, bounce back could be on, and we have had a bit of a bounce back from these highs back here. If you look at it from a more medium-term perspective, this uptrend is a bit of a look on a higher time frame. The upward bias is still there. The trend is still higher. Be looking for a bit of a pullback to get in. If you are one of those people, it seems a decent bet to get in if you manage to cloud out all the negativity in markets over the course of today. But a little bit tricky in terms of shorter term direction. Well, that is where we are at. Keep an eye on these lows on stock indexes. Keep an eye on those bond yields. Do markets continue to sour into the US session, or do we get a bounce back? That remains to be seen in about 10 minutes time.